The key to navigating these costs is a proactive strategy. And that's where personalized planning becomes absolutely essential.
I'm Dr. Alexander Reed, and my mission is simple: helping you protect both your health and your hard-earned savings as you navigate retirement.
For more than 40 years, almost nobody has looked closely at one line on their tax return. Line 6B. That's the line where the IRS writes down exactly how much of your Social Security check they get to tax. Your benefit goes on line 6A. The taxable part, their part, goes on 6B. And here's what should stop you cold. The rule that decides the number on that line was written in 1983, switched on in 1984, and it has not been raised, adjusted, or touched for inflation in over 4 decades. Think about that. Your groceries cost 4 times what they cost in 1984. Your house is worth 10 times what it was. Even your Social Security check has gone up every single year with the cost of living. But the income line that decides whether Uncle Sam taxes that check? Frozen. Stuck. Exactly where 2 men in suits parked it when Ghostbusters was in theaters. And because it never moves, it quietly reaches deeper into your pocket every year you live. When this rule started, it was designed to touch about 1 in 10 retirees, the wealthy ones. Today, it reaches about half of everyone collecting Social Security. Half. That's not because seniors got rich, it's because the line never moved while life got more expensive around it. So here's my contrarian promise to you, and I mean it. The advice you've been given, don't worry, most of Social Security isn't taxed, is quietly costing you money right now. Because the system was built to slowly pull more of you across that line every single year, and nobody at the bank or the Social Security office is going to call you up and warn you. In the next few minutes, I'm going to show you exactly how this 1984 machine works, why it's catching middle-income retirees who never thought of themselves as wealthy, and this is the part that matters in 2026. The brand new $6,000 deduction that just opened up, why most seniors are going to leave it sitting on the table, and how you can use it before this window closes. Stay with me. The first action item costs you nothing but 10 minutes and a calculator. Now let me tell you who I am and why I'm the one telling you this. I've spent more than 25 years sitting at a desk across from people exactly like you. Retired teachers, retired nurses, small business owners who finally sold the shop, couples who did everything right, paid into the system their whole working lives, saved a little extra, planned a retirement they thought they'd earned. And year after year, I watched the same thing happen. They'd slide their paperwork across the desk, and I'd have to point to line 6B and explain why the government was taxing the very benefit they already paid for with 40 years of payroll taxes. And almost every single time, the same words, "Nobody ever told me that." That's the whole reason I do this. Not to sell you anything, not to scare you into some product. I don't have one. This channel is a wake-up call, plain and simple. I'm going to show you the lines on your own 1040 that the IRS will never explain to you, because explaining them isn't their job. It's mine. So let me be straight with you before we go 1 inch further, because this matters. Everything I'm about to say is education, not personalized advice. I am not your tax advisor and I am not your financial planner. I don't know your exact numbers, your state, or your health. Before you make a single move based on this video, you take what you learn here and you sit down with your own licensed tax professional or a fee-only financial advisor who can look at your actual return. Think of me as the friend who taps you on the shoulder and says, "Hey, go ask about this." The asking is up to you. And if you're the adult son or daughter who handles mom and dad's taxes every spring, stay right here too. This one's for you as much as them. You're the one who's going to catch this. If this is already useful, do me one small favor and subscribe, because the people who watch this channel are the people who refuse to be surprised by their own money. Now let's open up the machine. Here's what nobody's telling you. The taxing of your Social Security is not random. It's not bad luck. It's not the IRS picking on you. It is a predictable machine, and once you understand how the gears turn, you stop being its victim, and you start being the person who plans around it. Here's how the machine works. Before 1984, Social Security benefits were completely tax-free for every American who received them. Completely. Then in 1983, a commission was put together to fix Social Security's finances, and one of the things they recommended was taxing a portion of benefits for higher-income retirees. Congress agreed. The law took effect in 1984, and they drew a line in the sand. If your income crossed a certain number, part of your Social Security became taxable. For a single person, that number was $25,000. For a married couple, $32,000. Now here's the catch, and it is the most important sentence in this entire video. They wrote those numbers in permanent ink. They deliberately chose not to let them rise with inflation. Every other part of the tax code, your tax brackets, your standard deduction, quietly climbs a little each year so inflation doesn't punish you. But not these two numbers. 25,000, 32,000, frozen on purpose. And the income they measure against that frozen line isn't even your regular income. It's a special calculation. They call it your combined income or provisional income. And here's how you build it, because you need to know this number cold. You take all your other income, your pension, your IRA and 401k withdrawals, your dividends, any part-time work. Then you add any tax-free interest, like from municipal bonds. And then this is the part that catches people. You add half of your Social Security benefit on top. That total is the number that gets measured against the frozen line. Cross 25,000 single or 32,000 married, and up to half your benefits become taxable. Then in 1993, the second time Congress touched this, they added a higher tier. Cross 34,000 single or 44,000 married, and now up to 85% of your benefit can be dragged on to the taxable line. Those numbers were frozen too. And here's the cruelest gear in the whole machine, the one that has a name among people who do this for a living. They call it the tax torpedo. It works like this. Once you're sitting near that line, every extra dollar you pull out of your retirement account doesn't just get taxed by itself. It can also reach back and make another 50 or 85 cents of your Social Security taxable at the same time. So $1 of withdrawal can cause well more than $1 of new taxable income. Your real tax rate on that money, the rate that actually hits your wallet, can quietly spike far higher than the bracket you think you're in. People withdraw what feels like a safe amount, and the torpedo doubles the damage behind the scenes. They never see it coming because it never shows up as a separate line. It's just baked into the number on 6B. So picture the machine. The line never moves. But your Social Security check goes up a little every year with the cost of living raise. Your required withdrawals from your retirement accounts go up as you age. Maybe your savings account finally pays some real interest. Every one of those raises pushes your combined income up toward a line that is standing perfectly still. So every year, a few more retirees who were just under the line get pushed over it. That's not an accident. That is the machine working exactly as designed. The people who wrote it said the quiet part out loud. Over time, they expected nearly everyone to get pulled in. And here's where health quietly enters the picture. Because in retirement, your health and your money are tied together with a short rope. Say you have a good year, a quiet year, sitting comfortably under the line. Then a health event hits, a fall, a surgery, a spouse who needs care. Suddenly you have to pull $40,000 or $50,000 out of your IRA to cover what insurance won't. That withdrawal is income. It rockets your combined income up. And in the very same year you're dealing with a health crisis, the machine quietly flips a switch and starts taxing your Social Security on top of everything else. The health event triggers the withdrawal trips the frozen line, and the tax bill lands while you're at your most vulnerable. That's the spiral. And the only defense against a spiral is to see it coming. Understand that machine, and you're already ahead of most people who will ever collect a check. Let me make this real, because numbers on a line don't land until they have a face. Let me tell you about Ron and Carol. Now, they're a composite. I've changed the details, but I've sat across from this exact couple more times than I can count. Ron's 68, Carol's 67. He spent 31 years as a foreman at a parts plant. She kept the books for a dental office. Between them, they've got a modest pension, a couple of IRAs they were careful with, and Social Security. Not rich, comfortable. The kind of comfortable they worked their whole lives to earn. They had a plan, a 2-week trip down to a little rented place near the Gulf in Florida every winter. Carol had the whole thing mapped out. For years, they sat just under the line and paid almost no tax on their benefits. Then Ron turned 73, and the law required him to start taking money out of his IRA whether he needed it or not. That's the required minimum distribution, and it climbs as you age. That same year, the bank finally started paying real interest on their savings, so that got added in too. And of course, their Social Security had ticked up with the annual raise like it does. None of these were mistakes. Every single one was just life moving forward. But here's what happened. Their combined income crossed the frozen line and then crossed the second one. And just like that, 85% of their Social Security got pulled onto the taxable side of the return. They owed thousands they hadn't planned for. And because nobody had warned them, they hadn't set aside a dime for it. So to cover the surprise tax bill, they did the thing that breaks my heart every time. They canceled Florida, Carol's trip, 2 years running. Now here's what makes me angry. Almost none of that was necessary. If somebody had shown them this machine 5 years earlier, they had moves we're about to cover, that could have kept them under that line, or softened the blow, or spread the income out so it never spiked. The tax wasn't the tragedy. The surprise was the tragedy. The not knowing. Don't be Ron. Don't be the person who finds out about line 6B after it's already cost you the trip. Be the person who runs the number this week while you still have every move on the table. Let me give you one more, quicker, because it shows the other way this sneaks up, and again, this is a composite. The details change, but I've seen it cold. Walter, 71 widower. Careful, man. He'd done what every magazine told him to do. He'd moved a big chunk of his savings into municipal bonds because the interest was tax-free. And it was free of income tax. What Walter didn't know, because nobody told him, is that municipal bond interest still gets counted when they measure you against the Social Security line. So Walter, who was sure he'd built himself a tax-free income, watched his benefits get taxed anyway because of the very bonds he bought to avoid taxes. He'd outsmarted himself into the exact thing he was trying to dodge. When I showed him the line, he just sat back and said, "So the one thing I did to be careful is the thing that got me." Yeah, Walter. That's the machine. It punishes the people who think they've already solved it. Don't be Walter either. Being careful isn't the same as being informed. Two different things. Now let me give you those moves. 5 of them. None of them require you to buy a thing. All of them are doable this year, and every one of them is about the same goal. Controlling that combined income number so you decide where you land instead of letting the frozen line decide for you. The first move is the one almost everybody misses in 2026, so write it down. Claim the new senior deduction. Here's what happened. In 2025, a new tax law created an extra deduction just for people 65 and older, $6,000 per person. If you're married and you're both 65 or older, that's $12,000 between the two of you. And here's the beautiful part. You get it whether you take the standard deduction or you itemize. It stacks right on top. Why does this matter for the machine we just talked about? Because this deduction lowers your income. And remember, it's your income that gets measured against that frozen line. So for a lot of middle-income retirees, claiming this can pull your combined income back down under a threshold and untax a chunk of your Social Security that would otherwise have been taxed. Let me be honest with you, because credibility matters. This deduction does not repeal the tax on Social Security, and it does not move the frozen line. Anybody telling you the government just made Social Security tax-free is wrong. What it does is lower the income you're measured against, and for the right person, that's enough to drop you into a lower tier or out of taxation entirely. Here's the arithmetic punch. Say you and your spouse are both 65 plus, and you're in a modest tax bracket. That $12,000 deduction, just on its own, might save you somewhere around $1,400 in tax. Multiply that across the 4 years this thing is alive, and you're looking at real money, $5,000–6,000, that stays in your pocket instead of theirs. And that's before you count what you save by knocking yourself below the Social Security taxation line. Here's how you act on it. When you sit down to do your 2025 return, the one you're filing right now in early 2026, make sure whoever prepares it claims this on the new Schedule 1A. If you use software, make sure it asks your age. If you use a preparer, say the words out loud. Did you claim my senior deduction? Most of the time it's automatic, but most of the time is exactly how thousands of people miss it. One honest caveat, because I won't oversell. This deduction phases out for higher earners. It starts shrinking once a single filer's income passes $75,000 or a couple's passes $150,000, and it disappears entirely well above that. If that's you, you've got other moves. If you're a middle-income retiree, which most of you watching are, you get the full amount. Don't leave it on the table. And let me show you the second-order magic of this one with a quick example, because it's the part that gets people leaning forward. Say you're a single filer, 70 years old, and your combined income lands right around $28,000, just over the frozen line, so a slice of your Social Security is getting taxed. Now you claim your $6,000 senior deduction. That drops the income they measure down to around $22,000, back under $25,000. And just like that, the taxable part of your Social Security can fall to zero. Not reduced. Zero. Same benefit, same life, one deduction, and you step back across the line. That's why I lead with this move. For the right person, it doesn't just trim the tax, it switches it off. The second move is to manage where your retirement money comes from, your withdrawal order. Here's what they don't tell you at the bank when they help you set up your accounts. Money you pull from a traditional IRA or 401k counts toward that combined income line. But money you pull from a Roth does not. A Roth withdrawal doesn't show up in that calculation at all. So if you have both kinds of accounts, the order you tap them in is a lever you control. In a year where you're bumping up against the line, leaning a little more on Roth money and a little less on traditional money can keep you under the threshold. The health angle here is real too. If a medical year forces a big withdrawal, having a Roth bucket to pull from means you can cover the bill without the withdrawal spiking your taxes on top of your hospital bills. How you act on it? This week, write down every retirement account you have and label each one. Traditional or Roth, just knowing what you've got is step one. Then ask your advisor about a withdrawal sequence that protects you. That's the conversation that pays for itself. The third move builds on the second. Ask about Roth conversions in your lower income years. There's often a window in early retirement, after you stop working, but before required withdrawals and sometimes before you've even claimed Social Security, where your income dips low. That valley is golden. In those years, you can convert money from a traditional account into a Roth, pay tax on it at today's lower rate, and from then on, that money never counts against your Social Security line again. You're moving money out of the bucket that gets measured and into the bucket that doesn't. This is not a do-it-yourself move. Done wrong, the conversion itself spikes your income for that year. So the action here is specific. Ask your tax professional, do I have a low-income window where a Roth conversion makes sense? Let them run your actual numbers. But know that the window exists because most people sail right through it without using it. The fourth move is to watch the sneaky income that ambushes people. Two big ones. First, those municipal bonds people buy because they're tax-free. They are free of income tax. But, and almost nobody knows this, that interest still gets counted in your combined income for the Social Security calculation. So a retiree who loaded up on muni bonds thinking they were being tax smart can still get their benefits taxed because of them. Second, one-time spikes, selling a piece of property, cashing out a big investment, a large capital gain. Any of those can rocket you over the line for a single year. The move is to see these coming. If you know you're going to sell something big, talk to your advisor about timing it or spreading it across 2 tax years so it doesn't shove all your income into 1 year and trip both frozen lines at once. How you act on it this week. Pull out your last statement and look for tax-free interest. And look at anything you're planning to sell this year. Flag it. Bring it to your tax person before you pull the trigger, not after. And the fifth move is the simplest and the most powerful. Run your number every single year before tax season, not during it. Here's the brutal truth about the machine. By the time you're sitting in the preparer's office in March, the year is over. Every move I just gave you had to happen before December 31st. So the single most valuable habit you can build is this. Every fall, before the year closes, add it up. Your pension, your withdrawals, your interest, your dividends, plus half your Social Security. That's your combined income. Compare it to the lines 25 and 34 if you're single, 32 and 44 if you're married. Now you know exactly where you stand while you still have time to do something about it. That's the difference between steering and getting steered. 5 moves. And here's one insider tip that sits underneath all of them. The kind of thing they don't volunteer at the Social Security office. If you know some of your benefit is going to be taxable no matter what you do, you don't have to get ambushed by one big bill in April. You can ask Social Security to withhold a little tax from your check all year long. There's a simple form for it, the W-4V. It doesn't lower your tax. What it does is smooth it out so the money's already set aside and there's no nasty surprise at filing time and no underpayment penalty sneaking up on you. It's the difference between paying as you go and getting hit with the whole thing at once while you're trying to figure out where it came from. Quiet little lever. Almost nobody uses it. 5 moves and a lever. Now let me give you the order to do them in, because a list you don't act on is just trivia. Here's your simple plan. Don't panic. Don't make any big sudden moves. Don't let a YouTube video stampede you into anything. Slow and steady wins this one. This is about building a system so that emotion never drives your money in a crisis. This week, and I mean this week, while it's fresh, do 2 things. 1. Pull out last year's tax return and find line 6A and line 6B. Look at what they taxed. 2. Grab a single sheet of paper and write down every income source you have, plus half your Social Security, and add it up. That's your combined income. Now you can see with your own eyes which side of the frozen line you're on. That's the whole foundation. 10 minutes. This month, claim what's already yours. If you haven't filed your 2025 return yet, make absolutely sure that senior deduction gets claimed. Say it out loud to your preparer or check the box in your software. If you've already filed and you realize you missed it, don't panic. Ask your preparer whether it's worth amending. This is the move with a clock on it, so it goes first. Over the next 2 or 3 months, have the one conversation that changes everything. Take your sheet of paper to a licensed tax professional or a fee-only advisor and ask 3 plain questions. Where do I stand against the Social Security taxation line? What's the smartest order to pull my money? Do I have a window for a Roth conversion? That's it. You don't need to understand every gear. You just need to ask and let a professional who sees your real numbers steer. And then, going forward, make it a yearly habit. Every fall, before the year closes, you run your number again, because the line stays frozen, but your life keeps moving, and the gap between the two is where the surprises live. Write it down, keep the sheet, build the system. When you've got a system, a bad year can't ambush you, because you saw it coming in October instead of finding out in April. One more thing to fold into that yearly check, depending on where you live. The federal rule we've been talking about is the big one, but a handful of states also reach for a piece of your Social Security, while most leave it completely alone. If you're in one of the states that doesn't tax it, wonderful, one less thing. If you're in one that does, or you're thinking about moving in retirement, that's a real number to put on your sheet and a real question for your advisor. Don't guess. Ask, does my state tax my Social Security, and does that change if I move? For some retirees, that single answer is worth thousands a year all by itself. The point isn't to memorize every rule. The point is to ask the right questions of someone who knows your situation once a year on purpose. That's the plan. Boring on purpose. Boring is what protects you. Now I know the voice in your head. I've heard it across the desk 1,000 times, so let me answer it before it talks you out of acting. The first thing it says is, my advisor never mentioned this. My tax guy never brought it up. If it mattered, somebody would have told me. Here's the uncomfortable truth. Your tax preparer's job in the spring is to fill out the form correctly for the year that already happened. It is not their job to call you in October and coach you on next year. Most of them are buried and most of them aren't paid to. And the Social Security office? They send the check. They don't send a warning label. The silence you've experienced isn't proof that this doesn't matter. It's exactly how it stays hidden. Remember the rule of 3. Congress has put hands on this only 3 times in its history. They created it in 1983, they raised the ceiling in 1993, and they tucked a temporary patch into the 2025 law. 3 times in 40 years. Nobody is racing to explain it to you. That job fell to you. The second thing the voice says is, maybe I should just wait, see how it shakes out, deal with it next year. And I understand the pull of that, but here's the cost of waiting in plain terms. Every move I gave you, the deduction, the withdrawal order, the conversion, the timing, every single one of them has to happen inside the tax year. Wait, and the year closes, and the moves close with it. The senior deduction in particular is only guaranteed for 4 tax years before it's set to expire. Waiting isn't a neutral choice. Waiting is choosing to let the frozen line decide for you. So here's what's going to happen for most people watching this. They're going to nod along. They're going to think, good to know. And then they're going to close this video and do absolutely nothing. And next spring they'll be surprised all over again. That's not a knock on them. That's just human nature. We put off the boring stuff that doesn't have a deadline screaming in our face. But you've got a deadline. Don't be most people. And there's one last objection I have to knock down because it's the most dangerous one of all. The voice says, this is for rich people. I'm not wealthy. This doesn't apply to me. Listen to me carefully, because that exact belief is what keeps the machine fed. This rule was built in 1984 to touch only the well-off, and back then it did. But the line never moved, and the world did, and now it reaches a teacher's pension and a modest IRA and an ordinary Social Security check added together. You do not have to feel rich to cross $25,000 or $32,000 of combined income. Most middle-income retirees clear it without trying. The people who get hurt worst by this aren't the wealthy. The wealthy have advisors watching every line. It's the careful, ordinary retiree who assumes it's not their problem. That assumption is the trap. So if any part of you just thought, not me, that's exactly the person I made this for. So let's close this out because the window is open right now and it does not stay open forever. Here's the binary, and I'm going to give it to you straight. The senior deduction is alive for 4 tax years. Not 10. Not forever. 4. Unless Congress votes to renew it. And you should never build a plan on a maybe. The very first year you can claim it is the return you are filing right this minute. So there are 2 kinds of people watching this video. There are the people who hear this, run their number, and claim what's theirs. And they protect their savings and keep more of the benefit they spent 40 years paying for. And there are the people who hesitate, who wait for someday, who let the frozen line keep quietly reaching into their pocket year after year. The line doesn't care which one you are, but you get to choose. It's that simple. It's that brutal. Let me leave you with the arithmetic. Clean, no spin. A married couple, both 65 or older, who claims this deduction across all 4 years it's promised to exist, is looking at thousands of dollars kept, and for the couple it knocks back under the line, it's thousands more in Social Security that never gets taxed at all. Now compare that to the cost of doing nothing, a frozen line that creeps closer every year, a tax torpedo waiting near it, and a surprise bill that shows up exactly when you can least afford it. On one side, 10 minutes and a phone call to your tax person. On the other side, Carol's trip to Florida. That's the trade. When you put it that plainly, it isn't really a hard decision. It just requires you to actually make it. So here's what I want you to do, and I want you to do it now, not someday. Turn off this video. Go find last year's tax return. It's in a drawer or a folder or an email, and put your finger on line 6B. See what they took. Then write down your combined income on a single sheet of paper. That's your first action, and it costs you nothing but 10 minutes. Start today, because 6 months from now, you are going to be one of 2 people, the one who took control of this in 2026, or the one who wishes they had. And do me one favor before you go, because saying a thing out loud is how you make yourself act on it. Drop your single biggest worry about retirement taxes in the comments. Just one line, whatever it is. The folks in this community read each other's, and you'll see you're not the only one nobody warned. If this opened your eyes, hit like so it reaches another retiree who's about to get surprised by line 6B. And subscribe so you're never the last to know about the rules that quietly cost you money. The people who watch this channel don't get ambushed by their own taxes. Be one of them. I'll see you in the next one.